The Nifty 50 has delivered a 10% return over the last 1 year, with a good recovery coming in the last 2 months. But beneath the headline index move, the story is sharply split between clear sectoral winners and painful laggards. Let's break it down for you. Leading the pack is Shriram Finance, up a stunning 62%, making it the top gainer on the Nifty over the last year. The rally has been driven by strong loan growth, stable asset quality, and sustained demand in the used vehicle and MSME lending space. NBFCs with focused business models clearly found favor, not to forget the 125 bips cut in interest rates that also aided growth. Adding to the positive momentum, Shriram Finance also saw a strong re-rating after global major MUFG picked up a significant stake, strengthening its capital base, lowering funding costs and boosting long-term growth visibility. Loads of brokerage calls coming in with a positive rating on this one, even until the last week of the year. Auto stocks were the next big outperformers. Eicher Motors surged 54%, supported by robust Royal Enfield sales, premiumization and margin expansion. Again, GST slab rationalization and rate cuts, of course, aided growth. Maruti Suzuki jumped nearly 53%, aided by record market share, strong SUV demand, easing input costs and improving export momentum. Clearly, the rural recovery and consumer demand revival also played a major role in autos outperforming the broader market. Bajaj Finance, another heavyweight, gained over 47%, riding on consistent earnings delivery, cross-selling strength, and easing concerns around regulatory overhangs. Insurance also joined the party. SBI Life rose 44%, backed by steady premium growth, improving persistency ratios, and a better outlook for protection products. Among industrial plays, Hindalco was up nearly 39%, benefiting from strong aluminium prices, improved Novelis performance, and expectations of global demand stabilization. The bottom line, financials, autos, and select metal plays were clear outperformers, driven by earnings visibility, balance sheet strength, and demand revival. On the flip side, the biggest disappointment came from Tata Motors passenger vehicles, which saw a steep 50% decline. Not to forget, a key structural factor behind this weakness has been corporate restructuring via the demerger. And JLR's dismal performance, intense competition, and margin pressures all weighed heavily on sentiment. Trent slipped over 38% as valuation concerns and slowing discretionary consumption led to sharp profit booking after a strong multi-year rally. And IT stocks clearly underperformed the market. TCS fell over 20%, HCL Tech declined about 13%. The sector struggled due to weak global tech spending, delayed deal closures, pricing pressures, and cautious commentary from US and Europe clients. Power Grid also slipped 16%, impacted by tariff concerns, muted earnings growth, and lower than expected return ratios. And defensives weren't spared either. ITC fell over 13% as cigarette volume growth remained modest and FMCG margins faced pressure, prompting investors to rotate into faster growing pockets of the market. So while the Nifty managed to deliver double-digit returns thanks to the last leg recovery, the real alpha was clearly in stock and sector selection. Winners, financials, autos, select industrials, laggards, IT, power, utilities, consumption, all of these plays. As we head into 2026, earnings delivery, global rate cuts, and demand recovery trends will decide whether this leadership continues or rotates.
If you like the video, do like, comment, share and subscribe.